Welcome to the Banker Lamp. Please enjoy the video.
You begin by gathering what matters now: invoices, receipts, bank statements, and any Form 1099. This gives you the why behind each line. Once collected, open your ledger or accounting software and confirm your chart of accounts and numbering convention. It prevents errors later. Next, identify the transaction type: sale, purchase, expense, accrual, or adjustment, because that decides which accounts move. Do this immediately so entries flow logically, and you can post consistently without guesswork or backtracking. You now record the entry. First, pick the affected accounts and decide which side, debit or credit, changes based on account type. Assets increase with debits, liabilities with credits. Then assign precise amounts, dates, and a reference code, and attach the supporting document so you can verify later. Make sure to apply the balancing rule: total debits equal total credits. If they don't match, stop and recheck numbers and account choices before posting. This prevents reconciliation headaches down the line. You finish by running a trial balance to confirm everything balances and to catch discrepancies. Focus on amounts greater than $1 or about 0.5% of totals. Once done, post recurring entries and schedule any reversing entries for accruals at period start or end so income/expense match correctly. If something goes wrong, document the adjustment with reason, author, and date, then trace back to source docs. This audit trail helps you fix root causes instead of masking.
Thanks for watching. If this was helpful, leave a like and consider subscribing. See you next time.